Hello there. Welcome to The Open here on BNN Bloomberg. Let's get to those big stories we're bringing you from the newsroom. We're standing by to for the interest rate announcement by the Bank of Canada this morning at 9:45 a.m. Eastern Time. The central bank is widely expected to keep its benchmark interest rate unchanged at 2.25%. The bank has been grappling with multiple factors that have clouded the outlook for inflation and the economy. Aecon Group beat expectations on first quarter revenue. It was up 18%. The Toronto-based engineering company also posted a record backlog of almost $11 billion. The firm says it expects 2026 revenue to rise further on growth in new markets, recurring revenue programs, and strong opportunities in power generation, resource development, and defense. Shares in Starbucks up about 5% in the pre-market. The coffee chain boosted its same-store sales forecast for the full year. U.S. consumers have been placing more orders and spending more money per transaction on food and beverage toppings. This helped offset slower growth in China. Products such as customizable refreshers are bringing guests in. Total revenue and U.S. sales for the second quarter were higher. It looks like we're going to get a pretty flat open this morning for U.S. equities. Let's see how the TSX traded yesterday. And you can see our market has been flagging over the past couple of sessions. Let's have a look now at oil this morning. Oil is higher amid no clear resolution on when normal transit through the Strait of Hormuz will resume, although there were reports of some ships, tankers, clearing the waterway. And let's have a look at gold this morning. We're also going to hear the interest rate announcement from the Federal Reserve as well. And of course, it could be bad for gold if the Fed hints at higher interest rates or at least flat interest rates over the next few months. And finally, let's see how our dollar is doing, the Canadian dollar. And you can see it is edging higher today. Ottawa released an update on the public finances yesterday afternoon. Let's break it down and get his key takeaways. We're joined by Kevin Page, President and CEO of the IFSD and former head of the Parliamentary Budget Office. Kevin, great to see you, and thanks very much for joining us.
Great to be with you, Andy.
Against the backdrop of a government wrestling with lots of economic uncertainties, higher energy prices, the ongoing trade conflict, what did you think of this budget update? Did anything jump out for you, Kevin?
Well, I think, there's a number of headline stories. One, probably, Andy, is the deficit coming in much lower than they anticipated just in the November budget. So, $11 billion lower, down from, 78 to about $66 billion. That means we'll likely have a deficit, a budgetary deficit, federal budgetary deficit in about the 2% range. And it stays relatively flat over the next few years. I think, another headline, I think, for this update, Andy, would probably be that the government got a bit of a fiscal uplift or found some fiscal room thanks to the higher oil prices that you were just talking about. They effectively spend it. They didn't spend it on, capital formation. They spend it to really prop up a relatively weak expected economy in 2026. So, again, modest deficits, I think overall relative to GDP, still much better than most OECD countries. Debt to GDP ratio staying relatively flat, but a little bit lower than it was back in November. And more of a traditional update, about half the size of the budget, but still a lot of moving parts, a lot of measures.
And they have, a lot of this additional revenue apparently already spent on programs such as topping up the GST credit for lower income people.
Yeah, so I think definitely, I think what we learned from the government is there's two tracks to the Canada Strong program. There's, one track was very much more medium to long-term focused. This is, really it's about capital formation. It's about trade diversification. It's about, moving towards those NATO targets. I think the other track is still the short term, trying to stabilize the economy. Again, we're expecting real GDP to grow about 1%. We'll get another number from the governor, or maybe a similar number from the governor of the Bank of Canada with his monetary policy report. That's, Andy, very weak growth. We're operating like 1.5% to 2% below probably our potential in this environment. And, we're running a deficit of about 2 percentage points of GDP. So the second track is really about stabilizing the economy, dealing with these affordability challenges.
What do you think of budget discipline from the current government? Of course, they say they're on this big investment track, infrastructure, projects of national importance, etc. But are they showing signs of discipline on the deficit?
Well, I think on the positive, with respect to discipline, Annie, I would say that they're holding to the track of getting to something called an operating budget balance in 2028-29. They're after running deficits of about 1.5% of GDP that's capital related. I think the government could be criticized for not giving us more confidence that there are guardrails to deal with these, uncertain shocks that we're likely to experience over the next year. So we could easily be thrown off that track of an operating budget balance in 3 years. There's some pluses and minuses with respect to discipline. There's certainly opportunities to add additional discipline to fiscal planning.
Andrew Coyne, the Globe columnist, is pretty scathing about what he calls this phrase, a day-to-day operating balance. He reckons that's just mumbo jumbo, and the term has never been properly defined by the government.
Well, I think, Mr. Coyne is, obviously a bright journalist. I think it's good to have people poking away at these definitions of what is operating, what is capital. I think you could probably look at the definition the government is using and saying the government is being generous with the capital definition. I think, from the government's perspective, they see that Canada's, business capital formation has just been horrible. The government, they feel, has to step in, particularly to deal with, with these bigger infrastructure projects, get more foreign direct investment, but really support it with government investment. Personally, Andy, I'm actually happy with the split of operating and capital. I think for too long, we've not had transparency of what the government is spending in terms of its own capital or capital transfers. I think this is an additional amount of transparency that is good. And it's a nominal target, getting an operating balance budget in 2020-29. That's more reminiscent of Prime Ministers Chrétien and Martin back in the days of the late 1990s.
How bleak is the debt figure? And just to go back to Andrew Coyne for a second, he's citing C.D. Howe research, and he says the combined federal-provincial debt, according to C.D. Howe, is on its way to 82% by fiscal 2029. Are we not taking the debt seriously enough, do you think?
Well, I think Andrew's definitely right that, I think since prior to the 2008 financial crisis, we've seen a significant increase in debt, particularly, federal debt. We're up probably about 12 percentage points of GDP. I think, we could look back. We can go to the Department of Finance fiscal reference tables, Andy. We could see that where did that debt really accumulate? We had a big bump up in debt because of the financial crisis, an enormous bump up in debt, during, the COVID pandemic. So the government really stepped in those two shocks, to help Canadians, to help households and businesses. And so, now we have, the debt federal debt sitting at 42. Again, I think Andrew's probably using a net debt figure or maybe a gross debt figure for actually federal and provincial debt. It's elevated. Again, if we look at gross liabilities, as a percent of the economy, we're probably a little bit more than the OECD average. When you take into account of our public pension systems, it brings our debt way down. We're probably, we're leading the way with respect to low debt. But how did we get to this debt position? Two big crises, and where do we find ourselves? We're finding ourselves in another deep, potentially a trade/security shock, in 2025-26.
One area that I think you are faulting disclosure, or you say more information is needed, defense spending and the massive projected increase there?
Yeah, I think, again, one of the big pillars of the Canada Strong Plan is to build our military. For too long, we've seen defense spending relative to GDP in the 1% range. We're getting to 2% in 2025-26. The target is to get for core military spending the target is to get to 3.5%. So by 2035, there's an additional 1.5%, for military infrastructure. It's the biggest fiscal moving part, I think, in the fiscal planning framework, and yet we don't see it in the budgetary plan, and so we don't really know to what extent we're moving, in terms of our defense spending obligations towards those NATO targets, and yet it's such an important component. I think it's just an enormous transparency gap that has to be closed by the federal government sooner rather than later.
Kevin, thank you very much indeed. Kevin Page is head of the Institute of Fiscal Studies and Democracy, and of course, former head of the Parliamentary Budget Office. And we are going to be hearing from the CEO of the CDHO, Jeremy Cronick, in the next hour. We have lots more ahead. Earnings season a little over the halfway mark. We're going to zero in on results from some big Canadian companies after this. Both U.S. and Canadian earnings are pouring in this week. And we have some Canadian companies to focus on today, CN Rail and the Montreal-based IT services provider, CGI. Let's get more from Martin Cobb, Senior VP Equities at Lawrence Steinberg Wealth Management. Martin, thank you very much. You're not Lauren, you're Martin. Thanks for joining us.
You've done it again. Morning, Andy.
Morning. CN Rail, give us your thoughts. Are you long railway stocks generally? Anything jump out for you with these numbers?
Yes, we are. We own both CN Rail and CPKC. Now, if I could choose between having just looking at quarterly numbers for all companies or looking at anything but, I would firmly choose the latter, the anything but, because what can you glean from 13 weeks for a company that has 20,000 miles of tracks and 100,000 cars moving all over there? So I don't pay too much attention to it. But I like the rails today because they've been around for 100 years. They'll be around for another 100 years. They are a play on long-term economic growth, long-term trade. And through thick or thin, they continue to deliver over, the economic cycle. So like rail, we've been marginal buyers actually off it recently because the valuation on us, on that and also on CP is fairly attractive.
Yeah, Desjardins, though, does note that the stocks had that run up lately and says we could even get, there's nothing wrong with these numbers, but given the big rise in the shares, we could get a slightly negative reaction today.
Wouldn't surprise me. I guess we'll know in 20 minutes time or so when the market opens. But if you look at a longer term chart, you'll see that the stock really has been under pressure over the last three to 5 years, and that's not because the earnings have really disappointed, but simply because there's been a bit of a derating. I mean, we were taking money out of CN Rail, taking profits back in 2021, 2022 at 25 times earnings. Today it's trading in the mid to high teens. So yes, it's had a bit of a strong run in the last little while, and so it may see a little bit of profit taking today. But investing's long term, isn't it? It's not about this quarter, it's not about this year, it's about the next several years.
What about CGI? It's one of these blue chip software IT services stocks that has suffered. Would you be a buyer right now of GIB.A?
We've looked at it, and to be honest, we prefer Constellation Software, one that we added to our portfolio this year because of the downdraft in valuations that's happened to anything IT related, anything software related, or information services related. So CGI is a good business, and obviously more the IT services side than the software side. There are questions over maybe its economic moat, how it will stand some of the the pressures that are coming from AI related tools that others can provide, but I don't think it's going to disappear overnight. But again, much prefer Constellation Software, who's a buyer of software companies who've suddenly got an awful lot cheaper than they were a couple of years ago.
Sorry, Martin, give us your thinking there again. Why would you tend to prefer Constellation to CGI?
it's more in their own hands, their destiny, I would say, for Constellation. So if you look at CGI, IT services, there's a question mark over, what is the economic moat for that? If you look at Constellation, they have like 1,000 different software businesses, serving very small niche verticals, but their business model is about buying, other software businesses. And today they have a portfolio of something like 60,000 companies on their radar screen.
Wow.
And the valuation on those, you think, is a lot cheaper than it would have been, a couple of years ago. So I think there's more of a compounding of earnings at Constellation's much greater than you would have at like a CGI, which is more about just ongoing organic growth if they can achieve that.
The headline on Barron's is Starbucks is finally growing earnings again. It looks like investors were welcoming the latest news from them, the latest projections. Would you be a buyer of Starbucks?
We have been a buyer. We've been building up our position in Starbucks over the past couple of years. With the reason being that, the move to kind of just simplifying the business, getting back to basics, as that was the kind of terminology they used. It's encouraging today. You've seen, same-store sales globally, up 5%. In the US, the key market for them, up 7%. And the management talking about this being the turn in the turnaround. They still have a long way to go. They historically made mid-teens margins, and today they're only at kind of 10, 11%. But if they get back to mid-teens margins with some level of revenue growth, $5 per share, that's less than 20 times earnings for Starbucks historically, a stock that has commanded 30 times earnings.
Wow. Maybe you could put up a 10-year chart. I mean, obviously, they are part of the culture, and they've entered the language as a synonym for coffee in some ways. But are there glory days behind them, do you think, Martin?
I think the glory days probably are behind them, yes. I mean, it is really a US business. China's not really worked out. They've got out of that. They have some strong international markets, but the US is 70% of it. And it's reasonably saturated, in terms of, just the spread of stores. What's really happening is they just got overly complicated. I mean, it became just a place, I used to stand in queue for my tall black decaf. That's all I want. Don't want anything fancy in it. And it would take me 10 minutes, to get my drink. So I think they've got back to just simplifying things, customer service, being a place you want to go and hang out. It wasn't that difficult. I'm not saying I could do it, but it wasn't that difficult. But are the glory days coming back? No. But has the business still got a lot of attractive, characteristics? Yes.
Martin, I think we'll have to leave it there. It has been great working with you over the years. Really going to miss you. One of our favorite guests.
Absolutely, Andrew. I'm just saying, that with you departing, we too shall suffer from your knowledge and your just ability to teach us what is inside that head of yours will be missed.
Oh, that's a scary thought, what's in my head. Martin, thank you very much indeed. Martin Cobb, Senior VP Equities at Lawrence Steinberg Wealth Management. Up next, we're going to turn our attention back to that spring economic update. We're going to talk about affordability measures that do affect the average Canadian. We'll have more after the break. So the update, the economic update from the federal government didn't have a lot of new measures to improve affordability, but there were one or two things. Let's get more from our colleague at CTV News, Scott Hurst. Scott, thanks very much. Just walk us through a couple of the things the government is doing to reduce price pressures.
Andrew, good morning. You mentioned that affordability remains top of mind for so many Canadians from coast to coast. Cost of living remaining a huge concern, and that came into greater focus since the outbreak of the war in Iran in late February. And that, as we know, has led to a surge in energy prices, upending inflation forecasts, and all of that happening as the federal Liberals unveiled their spring economic update. As opinion polls are showing, Canadians want the government to focus much more on lowering the cost of living, what the government can do for Canadians right away when it comes to helping out on their bottom line. So the federal Liberals unveiled billions in new spending in their spring economic update. It showed a lower than projected deficit because of surging oil prices, but because of those higher prices, as we mentioned, due to the war in Iran, Canadian consumers are reeling. And so specifically when it comes to new measures to help us right away, there is not a whole lot in the spring economic update that will help Canadians right away. But economists are critical of the lack of long-term deficit reduction despite the improved financial outlook. The biggest new commitment is a promise to spend on skills training, close to $6 billion for what the government calls a Team Canada Strong program to recruit and train up to 100,000 skilled trades workers. There's also a commitment to lower how much people have to contribute to the Canada Pension Plan. But in terms of overall affordability measures, new affordability measures, there's not much else that's new that'll help Canadians right away. Instead, the government highlighting some of the pre-announced commitments, such as the Canada Groceries benefit and also the temporary excise tax break, Andrew, on gas and diesel, as some of the highlights from the spring economic update in terms of affordability.
And apparently they are going to do something to clear this backlog of tens of thousands of complaints by Canadian air travellers. They're going to transfer responsibility for the complaints to the Minister of Transport. I don't know how that will speed things up, but people are backed up in the system.
Yeah, that has been a concern for Canadians for quite some time, too. So this spring economic update covering, a lot of bases when it comes to things that impact Canadians on a day-to-day basis and also long-term. And so, the big focus, of course, is those affordability measures and the little things that can help along the way, not just when it comes to immediate pocketbook issues, but a whole range of other issues that Canadians feel that feel the impact of on a day-to-day basis.
It's interesting. CBC reported earlier this year that Transport Canada officials, aka the government, worked to delay efforts to help to make the airlines pay for the air passenger complaint system. So it sounds like the airlines have a lot of lobbying power in cabinet. In any case, Scott, I'm too cynical. Scott Hurst, our colleague at CTV News. Okay, let's take a look at U.S. futures as we count down to the opening bells. And you can see we're likely to get a pretty flat open for U.S. stocks this morning as we await the Fed's interest rate announcement as well. Tough job for central bankers these days. They got it wrong about how temporary inflation would be during COVID. Right now, of course, they're trying to assess how persistent this energy shock will be in pushing up prices. According to the Wall Street Journal, U.S. President Donald Trump is telling his people to prepare for an extended blockade of Iran. And it looks like no swift exit is available for the White House from this war that it launched with Israel. We have those opening bells next. There you have it, the opening bells at the NASDAQ. It's the Women's Bond Club ringing the bell. In New York, it's Pershing Square USA and Pershing Square. Bill Ackman's outfit is listing a fund in New York. And on the TSX, Marquette Ventures doing the honors. It's time for the first 50. Trading is getting underway. Let's check in on the stock market as we get going on this Wednesday morning. And we'll start off with the TSX. You can see stocks down in early trading. The market uncertain as to when we'll get any kind of decisive news on ending the conflict and the blockade in the Persian Gulf. American ships still officially blockading Iranian ports, and apparently vessels have been lining up behind the blockade. So you can see the S&P 500 also slipping as we await a tidal wave of tech earnings after the bell today. Couple of stocks of interest here. CN Rail reporting its quarter. No great surprise. The efficiency ratio not quite as good as analysts had hoped. You can see the stock is down about 3%, but the shares have been rallying sharply lately. and some stocks on our radar south of the border. Starbucks producing numbers that investors liked, the profitability better than expected, and Starbucks shares rallying. Of course, that company has been struggling to reinvent itself in recent years, speed up service, for example, and there are hopes that the turnaround is gathering pace at that company. Let's have a look at how Robinhood is trading today, the company at the center of the gamification of investing. That stock down, quarterly profit lagging estimates. There was weaker than expected transaction revenue. So you can see that stock giving up some ground. And let's have another look at oil. This morning, oil, we have seen North American crude go above that $100 level again this week, and not great for the inflation outlook. So we are seeing oil higher. Really, what appears to be an impasse applies over the Persian Gulf. And finally, let's have a look at gold. If oil does fuel inflation, that will delay interest rate cuts, and that's seen as bad for gold. Let's see how gold is trading today. And you can see it's down slightly. Deutsche Bank says that if the US dollar does decisively lose status as a reserve currency, gold could see $8,000 US on this so-called de-dollarization. And there's gold. Let's have a quick look at our currency, the Canadian dollar. Of course, a weaker US dollar long term would push up the loonie, would hurt Canadian competitiveness, though, arguably. Okay, market call yesterday. We were joined by Andrew Moffs, the real estate specialist, Senior VP, Portfolio Manager at Vision Capital. His focus, real estate stocks. His top ideas were Dream Industrial, Chartwell Retirement, and Go Residential REIT. That's the newly listed one, or relatively newly listed in Toronto, and it owns New York apartments. Today on the show, it's Bruce Campbell, President and Portfolio Manager at Stonecastle Investment Management. His focus, Canadian stocks. When we come back, we'll check out some of today's notable calls, including one on Celestica. Couple of notable calls today. Citi analyst Atif Malik is raising the firm's price target on Celestica and to $415 US from $338, and sticking with a buy rating on the shares. That company has upped its fiscal sales outlook. It's seeing accelerating business demand from customers for elaborate assemblies and equipment, particularly for AI-based computing. Celestica's profitability and better visibility are the reasons cited for that price target bump. And our second notable call is on Planet Fitness. RBC Capital analyst Logan Reich lowering the firm's price target on Planet Fitness to $85 US from $120, but sticking with an outperform rating ahead of Q1 results. RBC says despite recent underperformance, with the stock down about 40% this year, there's elevated uncertainty about ads and a recent CFO transition. So that's some of the reasons why they're cutting their price target, but they are sticking with the outperform. Up next, we're close to the Bank of Canada's latest announcement on interest rates. Stick with us. The Bank of Canada is widely expected to keep its benchmark interest rate unchanged this morning. We're close to that announcement, the interest rate announcement. We're joined by Earl Davis now, Head of Fixed Income and Money Markets at BMO Global Asset Management. Earl, thanks for joining us. You say that there are distinct signs of weakness in the Canadian economy. Tell us the major one or two phenomena that you're seeing.
Yeah, well, the major one is housing market. We see it continuing to decline and getting weaker. There's no expectation for that to turn around. So that is the distinct sign for me. Although the Bank of Canada does not directly focus on the housing market, it's an important indicator of future demand, and saying whether the excess supply will get wider or whether it'll narrow. And that's a big component in future expectations for easing from our perspective.
But I know this is not a new theme, but when you get geopolitical events like the Gulf pushing up energy costs or the tariff war, lower interest rates aren't always the tool to help.
No, they're not the tool to help. That is for sure, because they could stoke inflation. So it depends. So let's back up. The market right now is actually anticipating 2 hikes in 2026. We push back against that. We think there's a chance of an ease, although our confidence is getting less so in that. It's more likely going to be on hold for exactly the reasons that you bring up, inflation. Plus, there's other aspects that are, I would say, positively impacting Canada. One actually is higher oil increases higher oil price increases the GDP of Canada. We saw that in the economic update yesterday, a lower deficit than anticipated because of a windfall, which means there's room for more fiscal stimulus, which could be the substitute for easing. So yesterday's economic update actually reduces our confidence in an ease, because that is an ease when you're putting back money into the economy. So the other thing too is the US actually, we still do 70% of our trade in the US, and the numbers year to date have been surprisingly strong. So that means we benefit from that as well. So there's a number of things taken away from our confidence in an ease, but we definitely think it's a hold this year. We think the chances of a hike are not what the market thinks, which is 100% of 2 hikes this year is what the market's anticipating. So one other thing, it'll be interesting to see if the Bank of Canada pushes back on that in their statement. That's one of the things we're looking at as investors. Do they push back on what the market is thinking, or do they kind of allude to, you know what, growth is stronger, inflation higher in the NPR, which means they're more thinking what the market's thinking. So that today's statement is very important.
So the market is generally pessimistic, you mean, on Canadian growth, but the Bank of Canada may say, hey, things aren't that bad?
No, they're specifically pessimistic on inflation. In regards to higher inflation. And it is the Bank of Canada's mandate to fight inflation or to maintain inflation at the 2% target, which the core reading from last month was 1.9. But the challenge is, and this is where the risk is, it's not oil price, it's not gas price. It's the extension or a longer duration war, which then flows into your packaging through plastics and petrochemicals, flows into your transports for all goods in regards to their higher oil costs or gas costs and jet fuel being passed on to us, translate into higher fertilizer costs, which is higher food again, higher helium costs, which goes into chips. So the longer this goes on, the breadth of inflation expands, the possibility for inflation expectations to go higher increases dramatically. That is what central banks, especially ones with inflation mandates, will push against. So we will see whether they kind of allude to a bit more hawkishness or they push back against it. It's very important. We believe they'll push back against it just to keep all options open, because CUSMA hasn't been settled yet. So that's the big wild card in the room.
You do expect, of course, it all may change at 9:45, but you do expect one more interest rate cut in Canada this year?
Yeah, just from the housing perspective. So, and the sequencing of the way things go. Yes, now we do think we're going to come into a period over the summer where inflation expectations will rise. So you could discount the full 2 hikes and maybe possibly more. But after the inflation expectations rise and you get this broadening of inflation, you get demand destruction. So it's the demand destruction, which we think will be a Q4 story. So it's not going to be for over the next 4 months or 5 months, but a Q4 story could be demand destruction. And if there is demand destruction, not just domestically, but globally, you could see an ease come in to help alleviate or to help increase demand.
I just wanted to loop back to something there, the impact of higher oil prices on the Canadian economy. I know there's multiple factors, and sure, higher crude prices help our terms of trade and our exports, but they must be a significant drag in that we import oil to central Canada, where most of the population is.
Yeah, you know what? There's be winners and losers within Canada. You're totally right within Canada, but external to Canada, we're a winner. So it's more, how do you distribute, how do you slice the pieces of the pie? The pie is definitely bigger from a Canadian perspective with higher oil prices. That is undeniable. There's been a lot of studies that say actually Canada, out of developed market countries, including the US, benefits the most. Having said that, then it's a government's job by definition to redistribute. And that's what we'll see. So you are totally correct in regards to parts of Canada, but as a whole, Canada benefits from this.
Right. So the Bank of Canada, breaking news, keeping the target rate unchanged at 2.25%. There is a look at the Canadian dollar. And so they're holding it. They expect inflation will peak in April. And so that's their hope, obviously, that they do feel that this surge in energy costs has been contained. The Canadian dollar weakening, as we can see, after the Bank of Canada stuck with rates. So the Bank of Canada says growth did resume in Canada after a decline in the fourth quarter. It's now looking for annualized growth of 1.5% in Q1 and Q2. It's slightly upping the growth forecast for the whole year, 2026, to 1.2%, and sees it rising a little bit to 1.6% in 2027. But right now, they're saying GDP outlook, little change because of the Mideast conflict, and inflation expected to peak at around 3% in April. Earl, I know you've had no time to look at the Bank of Canada commentary, but it sounds like they're not sounding the alarm on inflation in any way.
Correct. I think you've highlighted, I haven't looked through it, but I believe you did highlight the most important statement in there, that they believe inflation will peak in April. Those are significant words. That's the pushback against the market to hikes. It's not to say that it still doesn't happen, but that is a definite explicit pushback against the market. So now what we do, now we have to see, now we're going to be data dependent and actually see what inflation does after April and before the next NPR to determine what the next Bank of Canada move is. But to me, that says a definite hold. There's no hike, possibly no ease, but a definite hold. That's what that one sentence said to me.
Right. I mean, they are with the
and sorry, a hold for the balance of 2026. Just let me clarify that.
Oh, I beg your pardon. So you had been thinking that they might cut again, but you think they're more signaling a hold now for the rest of the year?
Yeah, because of the second thing that you mentioned, higher growth expectations, even though they're marginally so.
Right.
That combines, there's actually the thing that the Bank of Canada looks at closely, which was recently released, which is the Business Outlook Survey, which is basically a survey of businesses in Canada. That optimism has increased slightly, but it also mentioned there that financial conditions have eased slightly as well, which is going in the right direction for businesses, which means there's no impetus for the Bank of Canada necessarily to ease financial conditions further. So that does change me to a hold, given today's statement. We would believe or play that there's a hold for the balance of the year.
Right. Of course, 1.2%, pretty low growth, but at least going in the right direction, according to the Bank of Canada. We're not getting a slower growth outlook at this stage.
Yes. Yes, and there's a number of things which could say that growth outlook, that's probably the low side of growth. So there's two things specifically. One is if the war in Iran comes to a resolution sooner rather than later, that is beneficial for the U.S. from a growth perspective, which is beneficial for Canada, which is upside surprise. And the other one is if there is a CUSMA agreement, that is very beneficial for Canada and definitely upside surprise.
We talked at the top, Earl, about weakness in the Canadian economy. Is there a decisive downturn going on in housing right now? We know in Ontario, for example, housing construction has stalled.
Yeah, I think it's easy. I think it's hard to argue that there's not a decisive downturn in housing. If you look at new starts in regards to the stalling of new housing, as you mentioned, if you look at pricing in regards to Canadian housing, like in the secondary market, that's going down. So I think that's unquestionable in regards to the economy, or housing. But the main thing, even more important than housing, is employment. So employment seems to have stabilized. And why that's more important, you need to be employed to pay your mortgage bills. You need to be employed to possibly buy a new house. That's why that's even more important than the actual housing. That has stabilized, but we'll see what housing continues to do from a future demand perspective in regards to if housing prices reduce, you don't get people buying housing. Maybe you get some rentals, but it's not helpful for overall demand.
We are seeing some weakness in the Canadian dollar right now, but I'm just checking the US dollar index because it could be part of the strength of the US currency. US currency is up marginally against world currencies right now, so that could be part of the reason for the drop in the Canadian dollar. It looks as though the bank, obviously the bank is in no rush to the Bank of Canada to make a definitive pronouncement on rates. But as you say, that seems to be important. They say inflation in April, 3%, and that's about as bad as it's going to get on their current projection.
Yeah, and before there, let's continue the conversation on the dollar for a second. There's two reasons why the dollar is slightly weaker. Some people were expecting a hawkish tilt to the Bank of Canada statement today, obviously saying inflation is going to peak in April is not a hawkish tilt. So that's one of the reasons from interest rate differential to the U.S. Why we're weaker. But there's another important reason, which we haven't spoken about as of yet, is that this afternoon, it's actually the FOMC.
Yes.
The U.S. will be making their announcement. And similar to what people were thinking in Canada, it's a very small contingent, maybe 10% or 15%. Some people feel there could be a hawkish tilt in the U.S. Fed, given that it's Powell's last statement, not necessarily in the statement, but in the question period. In regards to the inflation, employment, and economic outlook, what are the implications on interest rates going forward? So if there is a hawkish tilt there, you will see further weakness in the Canadian dollar.
Yeah, we're looking at the bond yield, bonds selling off marginally. Earl, we're tight for time. What is the crucial thing you'll be watching out for from Jay Powell today? Presumably he won't, I don't know, maybe he will comment on his future at the Fed, but he probably doesn't want to wade into the political turmoil. But in terms of monetary policy, what's the big thing you're looking out for from Jay Powell today?
Yeah, it's exactly what we just mentioned. If there's a subtle hawkish tilt,
yes,
because the market there expects no change in interest rates for the year. Individuals do expect there will be an ease once the new Fed governor comes in. So if he has a hawkish tilt, that's important. But it still depends on whether he stays on the board after he's governor or resigns his post because he's able to stay for several more years. If he does and he has a hawkish tilt today, that does have implications on monetary policy in the U.S. going forward. Thank you very much, Earl. Really appreciate it. Thank you. Earl Davis is head of fixed income and money markets at BMO Global Asset Management. Now, a reminder that the Bank of Canada Governor Tiff Macklem and Bank of Canada Senior Deputy Governor Carolyn Rogers are set to hold their press conference at 10:30 a.m. Eastern Time or 7:30 a.m. Pacific, and they'll take questions on their latest decision to leave interest rates unchanged. Coming up, we did see that weakness in the Canadian dollar. We're going to update you on the TSX and some Canadian stocks of interest when we come back. Let's have a quick look at some stocks on the move on the TSX. We'll start off
with the TSX intraday, the Bank of Canada leaving rates unchanged and indicating that it thinks inflation will peak at around 3% this month. April, of course, we're almost out of the month. So the Bank of Canada essentially projecting at this stage that this surge in energy costs will be transient in terms of fueling broader inflation. Let's have a look at the financial stocks in Toronto. Some banks actually have been hitting record highs over the past few days, particularly CIBC, that leaps to mind. Great-West Life, another financial giant, hitting record highs. There's the financials index, big part of the TSX composite, slipping. Investors not loving the numbers from CGI, the big provider of IT services, and that stock trading close to a multi-year low. It's gone back to prices we saw, roughly looking at the chart, in 2022, 2021. So investors still worried that the rise of AI will eat into margins in IT services, but also worried about growth in CGI's important U.S. federal government business. And that stock, as of today, down around 23%. Let's have a look just as a bellwether for oil market sentiment at CNQ, Canadian Natural Resources. We have seen oil going above $100 this week, and CNQ's had a bit of a bounce right now, trading at almost $65. It was less than $61 on Friday. So investors moving into that one. Interesting as well, we get these big tech earnings tonight, and that will have implications for the likes of Celestica. Maybe we could have a look at a 1 week for Celestica. That stock was punished yesterday. The company's still growing rapidly, but not posting the exponential growth that some investors had hoped. So you can see Celestica stock rallying today, but down something like 9% this week. Coming up, more on the Bank of Canada standing pat on interest rates despite trade tensions and the oil shock. We'll have more with the C.D. Howe Institute's Jeremy Cronick. Welcome to the second hour of The Open. Let's get to those big stories we're bringing you from our newsroom. Bank of Canada is keeping its main interest rate unchanged at 2.25% and says it is going to look through the Iran war's immediate impact on inflation. Governor Tiff Macklem says a rate cut may be needed should the U.S. impose significant new trade restrictions. The bank thinks that inflation will peak at around 3% this month. The central bank also slightly revised upwards the growth forecast to 1.2% this year and 1.6% in 2027. The federal government's spring economic update, which we got yesterday, lowers the projected deficit by almost $12 billion. However, the figure is tracking to decline only nominally in years ahead. The extensive 167-page document released yesterday includes several measures, including investing billions of dollars in training and recruiting skilled trade workers, and millions for Canadian athletes and sporting events, and cutting the CPP contribution rate. Shares in CN Rail moving lower after the carrier missed profit and revenue estimates in its latest quarter. The firm did see, though, revenue growth in petroleum and chemicals, intermodal transport, and grain and fertilizer. However, metals and minerals and forest products and coal saw a revenue drop. CN Rail is pointing to ongoing uncertainty in the macroeconomy affecting performance. Health Canada has approved its first generic version of Ozempic, and this paves the way for cheaper access to popular diabetes and weight loss drugs. Ottawa says it's currently reviewing 8 other submissions for generic semaglutide by different companies. Semaglutide is the main ingredient in Ozempic. Launch preparations are underway, but no time frame has been provided. TSX stocks marginally lower today, in tandem with some selling we've seen south of the border as well. Let's have a look at the US benchmarks. You can see they're down in early trading. Bank of Canada holding rates steady, but it's still uncertainty just how this surge in energy prices and commodities, materials generally, will affect the economy. Let's get more from Jeremy Cronick, President and CEO of the C.D. Howe Institute. Jeremy, thanks very much. Start off with today's news, if you would. The Bank of Canada standing pat on interest rates and apparently comfortable that we're not in for a long-term rise in inflation.
Yeah, I mean, I think the bank at this point sees itself looking through the effects of the war in the Middle East and the effect on oil prices, and doesn't see it quite passing through to other sectors of the economy. But they did say in the announcement that they're gonna keep watching it, and when you combine it with all the other things they must watch, the Kuzma review and what that effect might be, and the balance of supply side and demand side effects, there's lots for the bank to watch. But I don't think they're suggesting that there's no concern, but at this point they don't see it passing through to the rest of the economy.
Could we turn to yesterday's update? Now, you guys at the C.D. Howe have been sounding the alarm on government debt, not just federal borrowing. I see there's a piece, Don Drummond, Alexandra Loran, and William Robson of your shop published an op-ed in the Globe and Mail warning that governments in Canada are at risk of just staying stuck in fiscal fantasy when it comes to running up big debts. So, C.D. Howe, you've been sounding the alarm on this?
Well, I mean, so the point in that paper is when you add up one of the points in that paper is when you add up the federal government and the provincial government debts, in this economy, it's quite large, and the larger that gets, the more impact it has on our ability to do the things that we need to do when times are tough. And so that's the case that we're making, and there's more upward pressure on how much of that debt goes to just servicing that debt than there was when interest rates are lower. So I think it's a piece to make sure that we're keeping governments to account, but also to remind folks that we have to look at the entirety of the debt in this country, not just the federal government debt when we're thinking about the fiscal position.
AKA the provinces running up borrowings?
Right. The provinces, are a big part of this country's spending and its contributions to both economic growth, but also to the debts that we're running up. So yeah, we have to look at both.
And of course, we're in for this big run-up in defense spending. That's going to be tens of billions of dollars, presumably with borrowed money.
Yeah, right. So I think that's part of it. I think the idea in part is to see if when we shift things towards increased defense spending, do we get a boost in economic growth in other ways, right? So the government is investing quite a bit in there. I think they see it as investment, and to the extent that it's investment, it hopefully creates more growth. But yeah, there's going to be some tough trade-offs when you're increasing defense spending from less than 2% to 3.5%, and then maybe eventually 5%.
I know one idea that's been raised by the C.D. Howe Institute, other economists have discussed it, perhaps increasing sales tax, perhaps even getting the provinces to increase their sales tax, so the federal government would be free to cut down on transfers and spend more on defense.
Well, so one of the points that we've made in the past in different papers that we've written is that the government relies pretty heavily, or the governments in Canada rely pretty heavily on income taxes, much less so than other countries that rely often on consumer-based taxes, which tend to be broader base. They tend to raise much more revenue. They also tend to be more controversial, and they also require offsets because they can be regressive, unlike income taxes. So, but when you are requiring as much new spending and potentially going into more debt, it is a way to raise a fair amount of revenue if you're the government.
Give us your outlook for the economy broadly. I know it depends so much on the CUSMA renegotiation, but so far, U.S. trade holding up fairly well, trade with the United States, despite all the to and fro on tariffs.
Yeah, so for the most part, during this period of trade uncertainty, we've had CUSMA, right? And CUSMA's covered, I think, something around 90% of trade. And so there's been obviously big tariffs in steel and aluminum and in autos, but so much of our trade has been covered by CUSMA, and I think that's made us far more resilient, but also has made this review of CUSMA coming up all the more important. The outlook, I think, is mixed. We see housing markets across the country that are stumbling. Manufacturing is now on a 3-year run of decline. The labor markets have been soft, and the Bank of Canada announcement highlighted this as well. So there's concern from the growth side of things, from the demand side of things. But then you have these inflationary pressures coming from oil. We saw food price growth over the last few months be quite high, and that affects cost of living. It affects consumers' inflation expectations, which the bank will have to manage because those short-term inflation expectations, if they start to get out of control, can be a problem. So, you have these kind of demand and supply side effects that in the end make it very hard to know which direction interest rates are going, which I think is partly why the bank paused or didn't change the rates today.
It's fascinating. I mean, the Bank of Canada juggling so much like central banks all around the world. Mr. Carney, the Prime Minister, has been resolute. He's willing to spend taxpayers' money to build up these so-called nationally important projects, invest in infrastructure. Is there one thing, though, that you'd like to see the Prime Minister emphasize or do that he has not been doing?
Yeah, I mean, that's a good question. I think maybe I'll return to something that he did start off doing, and there's admittedly a limit to how much the federal government can do here, but I'd like to see a renewed interest on internal trade barriers and the removal of those internal trade barriers. There are some estimates, when we were first dealing with the tariff threats from the U.S., there were some estimates that just removing internal trade barriers could offset the entirety of the loss in trade with the U.S. And while the federal government did do stuff, when it first came into power, there seems to be, a lost interest in that, and I think we should resume that as much as possible because it's a huge drag, on the economy, and it's a drag that we've had for decades now. It's a tough one, though, isn't it? Every bureaucrat has his or her little empire. They don't want to give up power by seeing rules cancelled. Well, that's right, and so maybe the federal government can use a little bit of leverage there, but it is difficult, admittedly. But if we don't know where the CUSMA review is going to end and what the future of that relationship looks like, as much as we can diversify internationally, which the federal government is trying to do, there are still geographic limitations, and when we have the opportunity here to reduce internal trade barriers, we may as well take advantage of it.
Thank you very much indeed. Really appreciate it.
Yeah, anytime.
Jeremy Cronick is President and CEO at the C.D. Howe Institute. Coming up, Calian, a TSX-listed company, is active in Canadian defence provision. We'll talk to the CEO after this about defence measures in the spring economic update. That's ahead. Ottawa has announced a couple of new measures to help improve Canada's defence and security capabilities. One of the biggest ideas here is turning the Defence Investment Agency into a standalone entity that would have its own cabinet minister. Let's get more from Patrick Houston, as CEO of Calian, which Desjardins calls one of Canada's few fully sovereign defense companies. So obviously you've a lot of interest here, Patrick, in what the government plans. Thanks very much for joining us.
Morning, Andrew. Thanks for having me on.
Can you remind us, what does Calian do in the area of defense for Canada?
Yeah, as you mentioned, Calian is a proudly Canadian company. Been in business for over 44 years. We've been doing a host of solutions in defense with the Canadian Armed Forces for over 25 years. It spans training, healthcare, IT services, as well as lots of new technologies we've brought to market in the last few years. And we've exported some of those to Europe recently and have been growing since the conflict in Ukraine started about 4 years ago.
How much of your, I'm just looking here, in your latest quarter, now correct me if I'm wrong, defense and space was about $140 million of your revenue. Essential industries were $69 million. So the bulk of your revenue was defense and space?
Yeah, last year, if you think of the fiscal year ending September 30th, we had over $500 million in defense and space. So I do think we are one of the scale players in Canada. And we've been doing that for a long time, and we're seeing significant growth. We just released an announcement just yesterday saying we had $200 million in new signings to support the Canadian Armed Forces in the quarter ended March 31st. So you'll see our results in a few weeks. I think this is a positive sign of some of the announcements you've been hearing in the news around defense and some of that coming and turning into action.
One of the things you actually do is provide medical services for the forces?
Correct. If you're a member of the military in Canada, you get all of your health care from the military directly. So we work hand in hand with the men and women who are enlisted in the military to deliver healthcare services. We've been doing that for over 15 years. We work across 26 bases and deliver what we call first-class care for everyone who's listed in the military.
Right. And you also have a nuclear business, do you?
We do have a nuclear business. We work with all of the operators. We bring engineering services, and we're working with Saskatchewan, Ontario, to build new nuclear across Canada. I think you've heard Prime Minister Carney talk about these nation-building projects, and the demand for energy is not slowing down. And I think nuclear is going to play a big part in that, and we're certainly part of that supply chain.
Defense bureaucracy is probably notorious in every country. I know it is in Britain and Canada. It often gets faulted for being too slow. Do you see real room? I mean, is there room for improvement on procurement, significant speeding up, for example?
Absolutely. And I think they recognize that. I was actually at a dinner last night with the Defense Investment Agency, and they recognize that part of their role, and you mentioned it in your opening, that there might be a new department starting next year, is to relook at how we procure in Canada. How do we engage industry, work hand in hand with them to bring these innovative solutions from Canada to the Canadian Armed Forces and speed up the procurement. The numbers they've announced in terms of meeting the 2% and then growing to 3.5% and then 5%, including infrastructure, are ambitious. And it's going to take a new way of doing things. But I think the Defense Agency is probably the first step in that, among many other steps.
It's going to be a real problem, isn't it, though? Even apparently in the Second World War, Canada had this sclerotic bureaucracy that would hold things up. So the government tried bringing in business people from private industry to unjam the process.
Yeah, and I think Prime Minister Carney has done that. I think he's nominated Mr. Guzman to lead the Defense Investment Agency, along with Minister Fuhrer. And they're bringing new people in with new thinking alongside a whole host of people that have an understanding of how the government works. So I think hopefully the combination of those two things leads to better procurement and better industry engagement. I think certainly industry in Canada around this is certainly excited about the direction it's going, and you're seeing a lot of new people come up that want to participate in this industry. And we're hopeful that those companies have the ability to work in defense, not only in the short term, but for decades.
Right. Of course, you reminded us there, Doug Guzman has been named CEO of the Defense Investment Agency. He was most recently deputy chair at Royal Bank of Canada. You mentioned that you've been selling some defense technology in Europe. What kind of sales have you been making? What's the product?
We do mission critical training. So we train both in the UK and for NATO countries. We train the military. This is something we've been doing for over 25 years. And more recently, probably in the last 5 years in Europe, with the conflicts in Ukraine and the deployments from all of the nations into European countries, the need to train together as a force. So, example, we led training in Latvia with France, Germany, and Canada to do exercises in order to prepare in case they're forced to fight together. And we also train all of the UK military land forces. So this is, training is a very key part of strong and secure defense. And we've been continuing to do that here over the last 25 years in Canada, and now we're excited to do it in Europe.
What kind of training? Like regular combat training?
No, large coordinated training. So this is usually bringing thousands of people together, bringing complex systems. So some of it is digital, some of it is in person, simulating different challenges. We certainly did a recent one where we worked with the Ukrainian forces to simulate what they're seeing and take some of the attack vectors that the Ukrainians see and train forces from Canada against it. And these are the things you need to do before you're able to go fight.
And do you have a bunch of former military types on staff?
Yeah, we're very proud. We have thousands of retired military people that work from us, both Canadians, Europeans, and that's a point of pride for us. So a lot of people who retire from the military often come work with Calian, and they're able to continue their career and train the new members of the military, and we're very proud of that.
Apparently, George S. Patton, the U.S. general, is reputed to have said, "Why is it that all battles are fought in the middle of the night in downpouring rain and at the corners of 4 different maps?" We kind of shrug off the enormous organizational challenges with military operations, but they're at the core, really, of what the military does.
Absolutely. Running a defense and meeting the requirements is probably one of the most complicated things that we do in Canada. The demand on the Canadian Armed Forces just continues to increase every year, whether those are demands here in Canada to meet wildfires and emergencies, as well as deploying people in Latvia, deploying peacekeeping missions, and working around the globe. So it is very complex. They've done an incredible job with the funding they've had. But when we go on bases and meet with the Canadian Armed Forces, I think they have a renewed sense of purpose. I think they feel the investment and the support of both Canadian government and the Canadian citizens that see the military as a key part of our sovereignty. And I think they're taking that positivity and, going to do some great things.
Patrick, thanks very much. Patrick Houston,
thank you, Andrew,
is a CEO of Calian CGY in Toronto. Coming up, Taiwan has overtaken Canada as the world's 6th biggest stock market. We're going to look at that on the ETF report. Time for the ETF report. Today, we're taking a look at Taiwan. The value, total market cap of that country's equity market has overtaken Canada's to become the world's 6th largest, driven by strong demand for tech shares, in particular those seen as plays on artificial intelligence. And we're talking here about the rapid rise of the chip giant Taiwan Semi. Now, there is an ETF that you can use to play that. It's called the iShares MSCI Taiwan ETF. And there are the big holdings. TSMC, that gigantic semi manufacturer at the center of the world's technology sector, is the biggest holding. It's about 1/5 of the ETF. Hon Hai there is an interesting company. It is the parent of Foxconn, which is famous as a contract manufacturer for Apple. About a decade ago, there was controversy over stress and the tough conditions for workers employed by Foxconn. So the Taiwanese market attracting attention here. And of course, there are fears that ultimately, if China, Beijing, steps up pressure on Taiwan, there could be a major problem here for the world's tech sector if manufacturing of those chips is curtailed. So Taiwan Semi, it trades as an ADR in the United States, and right now the market cap on that one going north of $2 trillion US. So EWT is the symbol for that ETF. And that's one of the great things I think about ETFs. They can let you say, I think that country's going to boom, and you can bet on it. It has a big market cap, this MSCI, the iShares Taiwan ETF. Market cap north of $8 billion US, getting on for $9 billion. I'm guessing the yield is not much good because that's not what people buy chip stocks for. Oh, actually, that's surprising. My Bloomberg screen is saying the net indicated yield is 1.2%. 12-month yield higher, but net indicated yield about 1.2%. And so far, this calendar year, that ETF doing just fine with people moving into Taiwan semi. What else can you do? So the ETF is up 85% in the past 12 months, and this year alone, it's up almost 40%. There is your ETF report for today. After this, we're going to go to the Bank of Canada news conference on today's decision to leave interest rates unchanged. Let's head over to Ottawa, where the Bank of Canada Governor Tiff Macklem and the Bank of Canada Senior Deputy Governor Carolyn Rogers are speaking on today's rate announcement.
To discuss the monetary policy report and today's decision. Governing Council maintained the policy interest rate at 2.25%. We've held the policy rate at this level since last October. We have three key messages today. First, Canada is being buffeted by global events and geopolitical uncertainties, but our economy is growing, and we expect it to continue to grow. Second, after more than a year with inflation close to the 2% target, higher global energy prices are pushing inflation up. The surge in gasoline prices, combined with still elevated food price inflation, is squeezing more Canadians. And third, monetary policy is focused on ensuring that the jump in energy prices does not turn into persistent inflation, while helping the economy adjust to global headwinds. We are committed to keeping inflation low and stable over time. On a trois messages clés. Premièrement, même si le Canada est secoué.
First, Canada is being buffeted by global events and geopolitical uncertainties, but our economy is growing and is expected to continue to grow. Second, after more than a year with inflation close to the 2% target, higher global energy prices are pushing inflation up. The surge in gasoline prices, combined with still elevated food price inflation, is squeezing more Canadians. And third, monetary policy is focused on ensuring that the jump in energy prices does not turn into persistent inflation, while helping the economy to adjust to global headwinds. We are committed to keeping inflation low and stable over time.
Let me expand on the economic outlook, the risks, and the implications for monetary policy. Since our previous forecast in January, the war in the Middle East has sent global energy prices sharply higher, increased financial market volatility, and disrupted shipping for fertilizer and other commodities. This has lowered the outlook for global growth while boosting inflation. In Canada, growth looks to have resumed after contracting at the end of 2025. Consumer and government spending are contributing to growth, while U.S. tariffs and trade uncertainty are weighing on exports and business investment. The labor market is soft, with the unemployment rate remaining in the 6.5% to 7% range, reflecting both weak hiring and fewer job seekers. Our forecast for GDP growth in Canada has not changed significantly since our January projection. The conflict in the Middle East will affect the composition of growth, but the impact on overall growth is expected to be small because higher global oil prices will increase the value of our energy exports, even as they squeeze consumers and many businesses. In our forecast today, the Bank of Canada projects the economy will expand 1.2% in 2026, 1.6% in 2027, and 1.7% in 2028, as growth in exports and business investment gradually resumes. With GDP growth slightly above potential, the current excess supply in the economy is slowly absorbed. Until the war, we expected inflation to stay close to the 2% target. But sharply higher gasoline prices are now pushing up inflation. CPI inflation rose from 1.8% in February to 2.4% in March. Core inflation has been easing and held steady just above 2% in March. The proportion of the components of the CPI basket rising faster than 3% has also declined in recent months. So far, there is little evidence that higher oil prices have fed through to other goods and services prices more broadly. But it is early days, and we will be watching this closely. We will also be closely monitoring inflation expectations. Near-term inflation expectations have moved up with higher gasoline prices and still elevated food price inflation. But longer-term inflation expectations remain anchored. Based on recent market expectations, oil prices are assumed to decline from an average of about $90 a barrel in the second quarter to about $75 a barrel by the middle of next year. If that happens, inflation should peak around 3% in April and then ease back to the 2% target by early next year. The Bank of Canada is committed to keeping inflation close to the 2% target over time. The monetary policy needed to achieve this will depend importantly on what happens with the Canada-US-Mexico trade agreement, how the conflict in the Middle East evolves, and the impacts of US tariffs and energy prices on our economy. À notre réunion cette semaine, on a décidé de...
At our meeting this week, we decided to maintain the policy rate at 2.25%. Governor Council agreed to look through the war's immediate impact on inflation, but if energy prices stay high, we will not let their effects become persistent inflation. Our baseline forecast assume that oil prices will come down and U.S. tariffs will remain at the current levels. If this holds true, a policy rate close to current settings looks appropriate to support adjustment in the economy and return inflation to the target. There may still be a need to adjust the policy rate depending on how the risks evolve. But if the economy evolves broadly in line with the base case, changes in the policy rate can be expected to be small. However, uncertainty is unusually elevated, and there are many possible outcomes. Monetary policy may need to be nimble.
At our meeting this week, we decided to maintain the policy rate at 2.25%. Governing Council agreed to look through the war's immediate impact on inflation, but if energy prices stay high, we will not let their effects become persistent inflation. Our baseline forecast assumes oil prices will come down and U.S. tariffs will remain at current levels. If this holds true, a policy rate close to the current setting looks appropriate to support the adjustment in the economy and return inflation to target. There may still be a need to adjust the policy rate depending on how risks evolve. But if the economy evolves broadly in line with the base case, changes in the policy rate can be expected to be small. However, uncertainty is unusually elevated, and there are many possible outcomes. Monetary policy may need to be nimble. If the United States imposes significant new trade restrictions on Canada, we may need to cut the policy rate further to support economic growth. Alternatively, if oil prices continue to increase, and particularly if they remain elevated, the risk that higher energy prices become ongoing inflation increases. And if this starts to happen, monetary policy will have more work to do. There may be a need for consecutive increases in the policy interest rate. Of course, these are not the only possible outcomes. We'll be watching developments closely and assessing their implications for growth and inflation. As the outlook evolves, we stand ready to respond as needed. The bank is committed to ensuring that Canadians continue to have confidence in price stability through this period of global upheaval. And with that, the Senior Deputy Governor and I will be very pleased to take your questions.
All right, we'll start with questions here in Ottawa and then go to reporters who are joining us remotely. We kindly ask that you limit yourself to one question so that we can get to every media outlet. Before asking your question, kindly state your name and affiliation. Libre à vous de poser votre question dans la langue officielle de votre choix. So we'll start with Reuters, followed by The Logic, then the Globe and Mail. So go ahead, Pramit.
Thanks, Becca. Good morning, Governor. With inflation in April expected to reach 3%, what is your message to households and businesses who might start demanding higher wages and the broader inflation expectations might also go up?
Well, first of all, we know higher oil prices are hitting Canadians. They're hitting businesses, they're hitting consumers. We've all gone to the gas station and filled up our tank. That's against a background where food price inflation has been running high for a number of months now. These price increases reflect global events. I mean, the best thing that could be to happen would be that these price increases go away at the source, but that's not something we can control. What can we control? What we can control is we can ensure that these price increases in particularly the surge in gasoline prices and other fuel prices, it doesn't become generalized, persistent inflation. Maintaining the policy rate today, where it is, was the right thing to do for today. And as we've indicated, if things evolve broadly in line with the outlook we've presented, and in particular, oil prices come down broadly in line with the futures curve, something close to the policy rate that we have today is probably about right. We might need a small adjustment, but I think it would be reasonable to expect small. But particularly if energy prices go higher, and particularly if they stay higher for longer, there could well be a need to increase the policy rate to get inflation back to 2%. And really the message is, we're committed to ensuring that inflation does stay close to 2% over time.
Go ahead, Kevin.
Good morning, Kevin Carmichael from The Logic. You had a look at how AI might be affecting productivity and updating potential output. Is that yet factoring into policy making here in the present? Maybe just talk a bit about how you're thinking about AI as you sit down to look at the rate trajectory.
Well, let me put it in broader context, Kevin. There's a few things affecting potential output, and once a year, as you know, we do a comprehensive review of our assessment of potential output and the outlook for potential going forward. And that is, we do that each year in the April monetary policy report. So there is a pretty detailed appendix on that in the report. Look, there are, I would say, three key things affecting potential in the outlook. Population growth is historically very low. There's basically, in our outlook, there's almost no population growth. So that means that, we're not adding new workers, new consumers, a lot of new workers, new consumers to the economy. So that lowers potential output going forward. The second factor is, and we've talked about this quite extensively in the last report and in some previous speeches, the Canadian economy is going through a structural adjustment. Our trade relationship with the United States is fundamentally changed. Businesses are adjusting to that. And as through that adjustment, that will weigh on productivity growth. Once you come out at the other side, things will be better, but there is a period of adjustment. And then the third, so those two things are weighing on potential output growth, particularly in the near term. The third factor, which what you mentioned, is AI. And there's no doubt that AI is a transformative technology, and as it gets adopted by more and more businesses, and as they use it in their businesses, we do expect to see a labor productivity growth pick up. And so that we have built in a modest increase from AI in productivity growth going forward. It builds over time. I think on average, it's adding about 0.2 to productivity growth in the projection. So taking those three things together, potential output growth is fairly weak in the near term, but as the restructuring advances and as the effects of AI accumulate, productivity growth picks up going forward. So that's built into our projection. Is AI having a big effect on our policy decision right now? No, but it is built into our projection, and it could end up that AI comes faster, has a bigger effect than we've expected. It might take longer. We'll see. That's something we'll be assessing going forward.
Go ahead, Mark.
Thanks for taking the question, Governor. So you spell out two kind of major risks. One is oil prices remain elevated and you're forced to raise interest rates. The other is the CUSMA talks take a turn for the worse and you are forced to cut. Those aren't mutually exclusive risks. What happens if we end up in a scenario where tariffs have risen, CUSMA talks have floundered, and oil prices remain high? How do you balance those risks?
Look, I provided a couple of examples, and I think the reason I provided those two examples is those are very salient assumptions in our projection around which, frankly, there is a lot of uncertainty, and it's not the regular kind of regular economic uncertainty. These are geopolitical events, so it's hard to assess probabilities as to exactly what's going to happen. And yes, as we outlined, the message really is that, look, today the best decision is to maintain, but monetary policy, the situation could change. Monetary policy may need to be nimble, and we provided a couple of examples. If there's significant new trade restrictions on Canada, that could have a material impact on the Canadian economy. We may need to cut to support growth. If oil prices go up, and particularly if they stay up, the risk that inflation becomes more persistent goes up, and there may need to be increases in the policy rate. And as we indicated, probably more than one, consecutive increases. Those are not the only things that could happen. To give you another example, financial markets have been very resilient through this. We could see an abrupt repricing in financial markets. That would be, another kind of shock that we would need to take into account. And as you indicated, the reality is more than one thing. There's many combinations of these things that could happen. In laying out those two examples, and in particular in showing the alternative case in the NPR with a permanently higher oil price, what we're trying to convey is, sort of the direction and the rough magnitude of how we would respond given certain given some different possible situations. Obviously, if it's a combination, it's going to be even more complicated, and we'll have to weigh various factors. The point of sort of laying out these alternatives is really to give a sense of how we would likely react in certain situations.
All right, next on my list, I have the Canadian Press, followed by CTV, then Market News. So go ahead, Craig.
Thank you, Craig Lord with the Canadian Press. Mark stole my question. I can figure out another one. With the the suggestion that you are prepared to potentially take consecutive increases to the policy rate if we see elevated and sustained global oil prices. What is the time frame that Canadians should be expecting you to be looking at these global oil prices? If we are at the end of the summer and we haven't seen much change in the global price of oil, should Canadians then be expecting interest rate hikes coming down the pipeline?
Look, obviously, the higher oil prices go, and the longer they're higher, the more the more likely it is that we'll have to raise rates to bring inflation back to target. But I want to stress, it's there is no set timeline here. It really depends on the conditions. It's going to depend, importantly, on yes, what oil prices do, what we think they're going to do going forward. It's all going to depend on what we see. How much are higher oil prices spilling into the prices of other goods and services? How much is our outlook for inflation changing? I mean, is that substantially increasing the persistence of inflation? So it's going to depend on those conditions. So, I mean, what I would stress is it's about the shock itself, and it's about the propagation of the shock. And if we're in a situation where the shock's bigger, and in particular it's more persistent, and we see clear evidence, we see growing evidence of propagation, that would be a clear signal that yes, rates probably do need to go higher to get inflation back to target.
Sorry, go ahead, Paul. Oh, sorry, Annie. Sorry.
Sort of a similar question to one of my colleagues, but you're talking about the potential impact of U.S. tariffs, but also of higher oil prices. And the Monetary Policy Report does outline what the situation could look like if oil remains at $100 a barrel. I'm wondering, what does the bank see as more of a pressing threat to the economy? Is it U.S. trade policy, potential U.S. tariffs being added, or oil prices being elevated and remaining closer to that $100 a barrel that you talk about in the Monetary Policy Report?
I think I'd come back to thinking about it in terms of time. So in the near term, the shock that's sort of hitting us most directly is the war in the Middle East. It's pushing oil up, and that's having an immediate impact on near-term inflation. And as the governor said, if that persists, that's going to that the risk increases that oil price starts to feed into the price of other things, and we need to deal with the inflation shock. Over the longer term, the trade tensions are the bigger threat to the Canadian economy, and there, we've got a restructuring underway, but we also have a review of the trade agreement that we're expecting to happen this summer. If there is a big change in that agreement, that could also present sort of a new shock to the economy too. So, sort of think about it in terms of two time frames.
Go ahead, Greg.
Greg Quinn, Market News. I wondered if having the policy rate now at the lower end of the so-called neutral range makes you a little more nervous about the potential need to tighten, and is this in another way why you're talking about a potential set of consecutive hikes?
Well, look, I would emphasize that there was a clear consensus on the Governing Council that the best thing to do today is maintain the policy interest rate where it is. But I will stress that there is no risk-free path for the policy interest rate. If we had raised rates now, and then oil prices come down in line with what the market's expecting, by the time those higher interest rates are impacting the economy, they wouldn't be needed, and we'd wished we hadn't raised the policy interest rate. But look, if oil prices stay high and we hold rates we maintain for too long, we could see higher energy prices spread to other prices of other goods and services and start to become more persistent inflation. In that case, we'll probably wish that we'd raised rates earlier. So we've got to manage both those risks, Greg. And as I said, I think there was a clear consensus that right now the best thing to do is maintain. But let me add two additional points of context. First of all, the current context is we're starting from a situation where inflation has been close to target for roughly a year and a half now. We're also starting in an economy where there's some slack. You can see it in the labor market. Our estimate of the output gap is, it's around minus 1%. So we're starting with some slack. So in that context, we don't think higher energy prices are going to be rapidly passed through to the prices of other goods and services. Because when there's some slack in the economy, when the labor market is soft, businesses they're cautious about passing on price increases. They're worried about losing clients. So we don't expect it'll be rapid. I think you're clearly going to see it in some places. You're already seeing fuel surcharges in some places. But we're not expecting it to rapidly broaden, but that's something that needs close monitoring. The other thing I would stress is that we know uncertainty is high, and we recognize that monetary policy may need to be nimble. If the situation changes, we may need to change course. And as I've said a couple of times, if oil prices go higher, and particularly if they stay higher for longer, that will increase the risk that inflation generalizes and becomes more persistent. And in that case, yes, we may well need consecutive increases in the policy rate to get inflation back to the 2% target.
All right. The next question will be from Bloomberg, followed by the Wall Street Journal, and then Global News. So go ahead, Najud.
Good morning, Governor. Cora is still stuck higher than the bank's target. You've given no indication you plan to fix any dislocation issues there. Is that still the case?
Sorry, can you just say the last part again? Core is above the target.
Yes. You've given no indication that you plan to fix any dislocation there. I'm just wondering if that's still the case.
Well, on core, just to take you back a bit, as you'll remember, total CPI inflation came down.
I'm asking a Cora.
Yeah, I know. I'm getting to core.
Sorry.
Our target is total, Najud.
So
don't forget.
I think she said.
Oh, Cora.
Yeah.
Oh,
yeah,
sorry.
So.
Okay, Cora. So you were talking about the fact that from time to time we need to do overnight operations.
Yeah. We've got a little bit of a margin, Jude, but we have some tolerance there. So you've called it a dislocation. I guess that's maybe a stronger term than what we would choose. So our market operations are basically back to sort of normal course. Our balance sheet's back to being normalized. So we keep an eye on Cora, but I guess we wouldn't characterize it as a dislocation.
Sorry about that. Cora.
Okay, Paul?
Governor, I wanted to maybe go back to previous questions, but what I want to know is what motivated you and the Governing Council to provide this form of forward guidance today about, when rates may increase or when rates may decrease?
Well, Paul, I wouldn't really characterize this so much as forward guidance, and it's not about when something's going to happen. It's about it's really more about our reaction function. It's about what, the Governing Council is very aware that there are a wide range of outcomes that are possible. And as part of our deliberations, we not only discussed what the best thing to do today is, but we also discussed what would we do if some of these other outcomes were to materialize, because you got to recognize that when you're taking there's a lot of uncertainty, and yes, we have a baseline outcome, but we're the first ones to admit that is not the only possible thing that could happen. And there is an unusually wide range of things that could happen. So as you discuss about what the best thing to do today is, you need to also be thinking about what how well positioned are you to deal with these other things? So that's why we discussed those. And having discussed those, I think it is useful to convey, certainly directionally, how we would handle these various outcomes. I think we're not the only ones grappling with this uncertainty. Everybody's trying to grapple with uncertainty. Our job is to be a source of stability, a source of predictability. So what we're saying is that, we're prepared to respond as needed, and we're giving some broad strokes as to what that could look like.
All right, Mac.
Mackenzie Gray with Global News. Talk about consecutive rate cuts probably gives you, and I'm sure some Canadians who might be watching, some nasty flashbacks to where we were with COVID. What lessons have you learned from that spike, and what do you plan to do differently this time to avoid a similar inflation run-up?
Well, maybe we could both take that one, since I think there's more than one lesson from COVID. Look, I think one of the key lessons from COVID is, as we were coming out of COVID, there was certainly a combination of shocks, very disrupted global supply chains that persisted for some time. Obviously, Russia's unprovoked attack of Ukraine really boosted food and energy prices. And the impact on inflation was large and it was rapid. And I think one of the lessons from COVID is that when the economy's already overheated, when it's already in excess demand, an additional, a big negative supply shock that boosts global energy and food prices can spread quickly to other goods and services. And it gets back a bit to my answer to Greg. It's the flip side of it. When the economy is already in excess demand, companies are having trouble actually keeping up with all the demand for their goods and services. So when their costs go up, they're like, well, we might as well just pass this right on. We're having trouble keeping up already. Let's just pass these price increases on. And that's what we saw in COVID. Not only were companies increasing prices by more, they were increasing prices more frequently. And to be frank, as a result, our models were having trouble keeping up with how fast inflation was going up. Today's situation is quite different. The economy is in excess supply. And as I said to Greg, against that background, businesses are a bit more cautious about passing on cost increases. Doesn't mean they won't pass them on at all. And certainly in businesses where energy is a big part of the cost structure, they have to pass some of it on. But they will tend to be more cautious. I don't know if you want to supplement that.
Well, Mark stole your question and Governor stole my answer, but maybe what I'd add is, you're right. When we're always our current thinking is always affected by what happened in the past, and it is true. Big consecutive increases in the interest rate. We know that's a pressure on Canadians, but what we also learned really clearly is that they don't like inflation either. Canadians don't like inflation either. So we would raise interest rates with the sole purpose of making sure we keep inflation at target. So.
All right, we'll go to the call now. I just want to remind people on the call to mute their line if they're not asking a question. So we'll go to Rob McLister.
Good morning, Rob McLister from MortgageLogic.news. You've mentioned it's especially vital to watch medium and longer term inflation expectations. So many Canadians are wondering what de-anchored expectations look like. So in the latest Business Outlook survey showed medium term or 2-year expectations at 3.4%, rising 60 basis points in a month. If the next 2-year expectations reading gets closer to 4%, would you still consider that to be anchored inflation expectations?
I think maybe what I would say, Rob, is when we look at inflation expectations, what we know about consumer inflation expectations, it's a bit different than business expectations. They're very affected by the current perception of inflation. And current perception of inflation is really very affected by the things you buy most often, everyday groceries and gas. And we know that the shocks we're seeing right now are pushing gas up, and groceries, food inflation has been a bit higher than headline inflation. So we keep that in mind when we look at how consumers view inflation expectations. More in general, what I would say is you need to be careful to look for trends versus month over month impacts on inflation expectations. So, we keep a very close eye. We look a little bit differently at how businesses see inflation expectations versus consumers. But what we're really looking for is an overall trend line. Is there a break point? I mean, what you're asking for, is there a number at which we completely change our view? No. We combine what we're seeing in that data with other things and other feedback we're getting and outreach and stuff. So there isn't sort of a number at which we turn from one view to another.
I just add, Rob, just to broaden this a little bit. I think one thing we're conscious of is that, coming out of COVID, inflation rose rapidly to just over 8%. And for many Canadians, this was really the first material inflation they had experienced in their lifetime. And unfortunately, a whole new generation of Canadians learned just how painful inflation is. And against that background, Canadians may be more attentive, may be more aware of the risks of inflation. And as Carolyn just mentioned, particularly when it's in food and gasoline, things people tend to buy every week, it can have a very immediate effect on their inflation expectations. So, there is a risk that inflation expectations aren't as well anchored as they were, before COVID. On the other hand, we demonstrated inflation went up just over 8%. We also brought it back down to 2% relatively quickly. I won't say it was without pain. It certainly was not easy for many Canadians, but we didn't cause a recession. We got it back without a recession. And what we saw in our own public trust, surveys of public trust in the Bank of Canada, when inflation went up to 8%, Canadians were quite rightly asking a lot of questions. Public trust in the Bank of Canada went down, but when inflation came back down and has remained at 2%, that public trust has come back down. So on that basis, it doesn't look like the credibility of the central bank and our resolve to keep inflation close to Canadians' confidence in price stability has been eroded. So these are more psychological factors, but as we assess what's happening with inflation expectations, we are alive that, we are cognizant of the fact that how people form their expectations may evolve over time. And that's something we'll certainly watching closely.
All right, that was the last question, and so that will conclude today's press conference. Thank you to the Governor, Senior Deputy Governor, for taking the questions, and to all of you for joining us. Merci.
Thank you.
Bank of Canada Governor and Senior Deputy Governor Carolyn Rogers talking to the media there. And Tiff Macklem really summed it up pretty well. If we had raised rates today and then oil comes down, we wouldn't have needed the hike. Meanwhile, though, of course, the tightening effect of an increase in borrowing costs would be working its way through the economy. By way of defending his decision, or the committee's decision to stand pat on borrowing costs, he said inflation's been near the target for 1.5 years, about 1.5 years, and we're seeing slack in the labour market. And he thinks, the bank at this stage thinks, that the upward pressure from higher oil prices won't be readily passed on to consumers because of slackness in the markets. Some will be, or slackness in the economy. Let's get a bit more, though, from Stuart Paul, Bloomberg economist, who is standing by. Thanks very much indeed for joining us, Stuart. What jumped out for you? Could you tell us, please?
Well, it's interesting. The press release, the monetary policy report, and Governor Macklem's opening statement all sort of read as a little bit hawkish. There was basically a threat that if energy prices remain higher, there's going to need to be a sequence of rate hikes. But riddled throughout both the press conference and the press release and the monetary policy report are really important acknowledgments, some of which you highlighted, which is core inflation is basically below 2%. The 3-month annualized pace of several measures of core inflation are below 2%. The diffusion of inflation is low. There's slack in the economy and the labor market is cool. And when that's the case, the risk of inflation pressures broadening and seeing those that sequence of rate hikes, that seems to be a pretty minute risk when I look at the economic landscape.
It's interesting. But you, I think, said there was a sort of a hawkish tone here, because certainly the Canadian dollar has recovered from its losses.
Yeah, I think that there was a hawkish tilt to a lot of what was going on. A lot of what was included in the press release and in the opening statement. There needs to be a little bit of jawboning around devotion to the 2% inflation target. There needs to be an acknowledgement that there could be rate hikes if the war is prolonged in Iran, in the Middle East, and energy prices stay elevated. There needs to be some of that that threat out there. In a sense, it's a way of signaling to producers and signaling to firms that there's a risk of cooling economic activity in the event that there were rate hikes. And there's a risk that if firms were to try to pass along higher prices, that they would face retrenching demand. And so that's how at least hit my eye. That's how I would assess the written comments. But I think that the risk of following through on that threat is pretty minute.
The bank, I mean, obviously stating the object obvious, sometimes central bankers have to do that. Say, if we do get hit with more tariffs by Washington, obviously we'll have to take another look at interest rates.
That's right. So I think that Deputy Governor Carolyn Rogers did a good job in laying out the sequence of events. Right now, the war in Iran is most front of mind, and USMCA negotiations are probably most important, but over the long run. Here's where I might differ from her a little bit, is that I think that when we think about the risks to global events, I think that the risk is that the war in Iran is prolonged, and the risk for USMCA negotiations is actually that they get settled and USMCA gets renewed rather soon, call it around mid-year, perhaps in July. Certainly, summer, tail end of the summer. And if that's the case, then the downside growth risk as a consequence of the reshuffling of trade with the U.S., that downside growth risk gets mitigated quite a bit. And the upside inflation risk becomes a little bit more serious. And there's a little bit more room for the central bank to hike. Right now, my base case is for one rate hike at year end. But I think that if we were to see a settlement of USMCA renegotiations in the middle of this year, we could see that rate hike pulled forward a little bit.
Stuart, thank you very much indeed. Stuart Paul, Bloomberg economist for the US and Canada. We've got to wrap up this edition of the Open. Morning Markets is coming your way.